Thanks so much, everybody, for your time today, depending upon where you're located around the country or around the world. We're so glad you're here with us today. We are live streaming this event on several platforms, including for those that have RSVP'd to the event via Zoom. We are recording the event today. So for those that are interested in sharing this information with others, or perhaps maybe you would like to listen in again to the recorded presentation, we will have the replay available. Please do reach out to a member of the Rise 48 team or Investors 1031 Exchange team, and we're more than happy to provide you with the replay video for today's session. This is one of the topics that we regularly hear from investors quite often, and that is about the 1031 exchange. We oftentimes have investors that will reach out to a member of the Rise 48 team. They're either in a scenario where they're an active or passive investor in a current commercial or residential property, and or they're maybe looking at the potential of exiting out of a business, whether that be a business that they own directly or maybe a franchise business that they have been involved with, and they're maybe looking for some succession plans or ways in which they can mitigate tax consequences associated with rolling out of real estate or another business. So I'm really excited to be accompanied here by Tommy Hinson from Investors 1031 Exchange. Tommy, thanks so much for bringing us some of your time today.
Yeah, appreciate the time.
Yeah, absolutely. So just without further ado, Tommy Hinson is the CEO of Investors 1031 Exchange, and I am the VP of Capital Formation at Rise 48, Jeremy Dyer. So with that said, I'm going to go ahead and turn it over to Tommy. This is going to be a little bit of a conversation between him and I. So I'm going to have him primarily do the main presenting here. But for those that have questions, would love for you to enter in those questions into our live Q&A box. We'll definitely get to those questions throughout the course of the investment presentation today, in addition to the fact that I'll be asking Tommy a few different questions as we go about it on the call today. So without further ado, Tommy, I'll go ahead and turn it over to you.
Okay, I appreciate it, Jeremy. Appreciate you guys being here today. We're gonna just kind of go over what the 1031 exchange is. The big thing is to kind of hit this at a high level. We don't want, obviously, anyone on the call doing tax advice. That's our job. But if we can help you understand this, it's a wealth building tool that, should come into play if you're, doing investment real estate and, hope to keep the money in your pocket. So just a little bit about us. We're what you call a qualified intermediary, or some call us an accommodator, but we're an independent accommodator, meaning that we're not tied to a title company or an escrow company, which honestly gives us the ability to do more advising. A lot of these other companies are strictly forbidden to advise clients on investment strategies, whereas us being independent, we're allowed to sit down with our clients, walk them through the process, and help them grow their wealth through investment real estate. So what a 1031 exchange is, it's actually an IRS code. It's one of the only loopholes that really work with investment real estate. But what it does is it allows an investor to defer paying capital gain taxes when selling an asset, which in this case is real estate. You will hear that it's tax deferred, not tax exempt. But ultimately, the plan is that you'll never end up paying the taxes. We call it swap until you drop. But the idea is that you sell investment real estate, you take that money, you buy more investment real estate or property used in a business. Ultimately, when you pass away and your heirs inherit those properties or that portfolio of property, the taxes go with you, and there's a step up in basis, meaning that at the date of death, the new value of that property is the new basis. So all the taxes go away. So it's a way to continue to build your wealth through real estate and never give the IRS or state any money in taxes. The way it works is you have to replace an asset with an asset of equal or greater value. So if you sell for $1 million, you have to buy for $1 million. And if you continue to do that, use all the cash, continue to buy at equal or greater value, then you end up paying no taxes on any of the gains.
Yeah, thanks, Tommy. And I know I've heard investors say many times before, that the strategy, with the 1031 exchange is defer, 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 die. So maybe you can kind of talk a little bit more about, kind of what that strategy means as far as that, maybe that step up or step down in basis. And then in addition to that, I'd love for you to maybe talk a little bit more about, what does qualify as proceeds through a 1031 exchange. It's not the cash flow that the investor receives over the course of the investment hold period, but rather it's their original investment plus any equity profit participation. Am I saying that right?
Yes, yeah, correct. So, basis is, one of those words that some people, don't understand. But if you look at it like this, if I buy my first rental property for $200,000 and I've just, got a rental, I'm creating rental income, that's great. But obviously, as we all know, over time, that property is going to appreciate. So now, 10 years from now, I'm going to sell that property for $400,000. What I have there is a $200,000 gain. And we'll kind of get into what that $200,000 gain looks like from a tax perspective. But that is what the 1031 exchange is able to do, is to take that gain, roll it into more property, and end up not paying any tax on it. So the basis goes up and down based on two things: capital improvements. So if I buy a property for $200,000 and I add, $100,000 in capital improvements, put in a new kitchen, all that type of stuff, it actually increases the basis. So now that $200,000 property, when I go to sell it for $400,000, is only a $100,000 gain because I created some capital improvements on it. On the flip side, if you depreciate the property, which you will depreciate the property, whether your CPA, has you do it or not, it's automatically fixed in. That lowers the basis. So as I depreciate these properties, over the lifespan of holding them, it actually lowers the basis. So if I bought that $200,000 property and I depreciated it 100,000, now I could have, up to a $400,000 gain. So those are the two things that affect the basis. But for 1031 purposes, none of that will really matter because you're going to continue to, buy more property, use all the cash, and avoid all of those taxes.
Yeah, it makes total sense, Tommy. One of the questions that we get from a lot of folks is, I'm selling a property that's eligible, for a 1031 exchange. Maybe it's a single family home, or maybe it's even a small business, for all intensive purposes. And they're looking for that asset of equal or greater value, right? And so typically, if you're coming out of a single family residential home, for example, it might be tricky to find something to replace that relinquished property with on the replacement side. Is that a challenge that you oftentimes will see with investors as well?
Yeah, it is. And there's a lot of opportunities that we can look at, throughout this presentation to kind of show you what some of the strategies are to do that. And we will go into, what the different kinds of properties are. There's a term called like kind that we'll kind of get into. But just so you know, this full code is based on properties that are held for investment or properties used in a business. The primary home doesn't qualify. But you can, move that money to multiple different investment strategies that we can, walk you through here shortly. So there's different types of exchanges. The main one that most people are familiar with is the forward exchange, and that means I'm going to sell a property. I'm going to take that money and go buy another property or multiple properties with it. You can actually buy more than one. There's the simultaneous, which we try to stay away from. That means that you're going to sell a property today and you're going to buy a property today. We just had one yesterday, and it's, especially, depending on where you're at in the country, that can move very quickly because you've got a property that sells, escrow sends the money, and then that money has to get moved to the new escrow or title company or attorney, depending on what state you're in. That's the simultaneous. A delayed forward exchange just means that you're going to sell a property and then ultimately buy another property. We'll go over what those timelines have to be, but that's the majority of what we deal with is the forward delayed. So you're going to sell a property and then have a certain amount of time to buy another property. The other one that's becoming very popular now, and as Jeremy said, there's a lot of situations where you find a property that you want to acquire, And there's not going to be contingencies in this market because there's limited supply. So what some investors are able to do is they're able to go ahead and acquire a property first and then sell their other property that they ultimately want to sell, which we call the relinquished property. And when they do that, then they can pay themselves back for the property they already acquired or pay off the loan that they used to acquire that second property. So we could have a whole seminar on how a reverse exchange works, but ultimately what you have to do is you have to put it into an SPE, which is an LLC, to take one of the properties. So we call it exchange first, meaning that you're going to take the property that you're going to ultimately sell and put it into a different entity and then acquire the property in your own name, or you're going to acquire the new property in this special entity, sell your property, and then that entity becomes your entity ultimately. So again, a lot of details on that, but just to let you know, there is the ability to acquire first, sell second. Then there's the build to suit or improvement exchange, which means that you could actually sell a property for called $1 million and go buy a property for $800,000, meaning you still have $200,000 left over. You could actually take that $200,000 and improve the property that you acquire. So again, there's a lot of moving parts with all that. We'd be happy to walk you through, but just for information purposes, you can buy first, sell second, and you can buy a less value and ultimately end up putting that money into improving properties. So we can walk through that if needed.
Yeah, it makes total sense. There's a couple of questions that folks have been asking as you've been covering this particular slide, and that is, what if the relinquished property is owned within the confines of a corporation? And I think the genesis of this question is does the ownership structure as it exists today with the relinquished property have to be the same into the replacement property, if I'm saying that right?
Yes, yeah, you are. And that can be confusing. We get a lot of people that are like, well, this property's in my trust. Can I buy this property in my name? A lot of residential, you can't buy properties in special purpose entities like LLCs or partnerships. What they're trying to follow here is the tax-paying entity. So if you're a single purpose or a single member LLC, that's what we call a disregarded or a pass-through entity, meaning that the taxes for that entity goes directly to your social security number. Where it becomes an issue is if you're in a partnership. So if my father and I go create an LLC and we're both members of it, it means it becomes a partnership. It's not a single purpose entity or a single member entity. It's a partnership. So what that means is the partnership owns the property and what we own is the partnership. And so when you sell a property in a partnership or an S Corp or a C Corp, that is the taxpaying entity that sells. That is the taxpaying entity that has to acquire. If it's a single member or it's a trust or it's your individual name, then you can switch it into another LLC or into an S Corp or whatever you want, as long as that taxpaying entity stays the same. Remember, we're deferring taxes. So that taxpaying entity that relinquishes has to be the taxpaying entity that acquires. And so that's the way that's set up. If I could say one more thing on that is that partnerships can become a real problem when it comes to doing 1031 exchanges. We get multiple calls a year that me and my partner bought this property. We created an LLC to own the property, and now we want to sell it. One of us wants to move on. One of us wants a 1031 exchange. That becomes a real problem because that entity has to stay together in order to buy the new property. And so what you end up with is how you can cash out one person and not cash out the other. So the rule is own the property as a tenant in common interest, meaning your LLC and my father's LLC can own the property as 50% interest each. That way, if his interest, he wants to sell it, pay his taxes, that's fine. I can exchange mine and move forward. But it's very difficult to do the partnerships. And so can't stress enough. And we tell real estate agents and brokers all over the country, make sure that your clients know we don't want to own properties in a partnership. We want to hold them in TIC or DST or TIC interest, which we'll kind of go over. So here's the big hard part about a 1031 exchange. When you sell the relinquished property, and it closes escrow, that's when the time clock starts. There's two different deadlines when it comes to a 1031 exchange. The first one is the 45-day identification period. And what that means is the day I close escrow, I have 45 days to identify what I'm going to invest in next. And the way that works is three different ways. There's the three property rule, which is simply you're going to send me a form. I'm going to send you a form. You're going to fill it out that shows these are my three choices. So option one is I'm going to buy this. Option two is this. If that doesn't work, then here's option three. That's primarily how most people do it. They already have a pretty good idea. They're going to sell an apartment building. They've got another apartment building they've already got their eye on, and that's why they're considering doing this. But you always want those second and third choices, because if that first one doesn't work out, you can end up in a real problem. The other one is the 200% fair market value. What this means is if I sell a property for $1 million, I can identify up to $2 million worth of properties. So that's for people that want to, go beyond the three property rule. They're not quite sure what they want to do. We rarely see the 200% rule. If you just have more choices, you can always call us. We will walk you through how to do that, how to create the fair market value, and kind of get through that. Then there's the 95% exception, which is very rare. This is for portfolio purchases. So you'll see a lot of this happen when people are buying, large portfolios of property. What that means is that you can identify up to as many properties as you want for any value that you want. But after that 45th day at midnight, you are set to buy 95% of what you identified. So that's where you really know what you're doing. You really know what you're going to acquire. It's more than three properties. It's more than 200%, but we already know what the plan is. So we're going to put them all down and then ultimately end up acquiring a minimum of 95% of those. So this is the tough one. The strategies are delay your closing date, which we know none of us want to do. We want to get this thing sold and get it closed. But you really got to start looking for those properties early, because 45 days comes pretty quickly. The other option is that we advise a lot of our clients to do, and Rise48's been great at this, is consider using the TIC. Now, what a TIC is a tenant in common, and what that is you can buy fractional ownership interest in a large piece of real estate. So you could ultimately end up buying into a $150 million piece of real estate with the property you sold for $300,000. But you'll own, 1% or 0.64%. So you're on title, you are an owner of the property, but you're in a syndicate, meaning that there's other owners on the property too. Those are great fallback options. What we're seeing today, especially with, the baby boomers moving on, is that we're seeing more and more people that like these types of investments instead of doing the traditional stuff where they have to manage them, they have to buy them, they have to go get the loan. With these syndicates, they're fully passive investments. And so you've got, groups like Rise48 that actually manages the property, deals with the tenants, gets the debt, all of that. So you're literally a passive investor. You avoided the taxes, and now you can get your monthly checks. And then ultimately, when that property sells, you can do another 1031 exchange and continue to move on. So that's the tenant in common, which you'll hear called a TIC. The DST is a very similar platform. It's called a Delaware Statutory Trust. That's where you're not on title, you're a beneficiary in a trust. So the trust would own the property. You're a beneficiary in that trust. You have no voting rights. You can have up to 500 investors in a DST. We lean more towards the TIC structure that gives you, more control of the property and control of your own interests. But those are the two platforms you can use to go into more of a passive investment.
Yeah, I think based on what I'm hearing here, Tommy, from you, is it's really important that if an investor is looking to roll out of a property or a business and execute the 1031 exchange, strategy, that they really need to be planning well in advance, which includes a couple of things. Number one, identifying a best-in-class qualified intermediary or QI to start the planning process. The second of which is to make sure that you've identified a number of potential replacement properties which come and they go, right? For example, with Rise48, when we launch a new dealer investment opportunity, we typically fund those investments within, 1 to 3 weeks. And that opportunity may be here today, but may be gone tomorrow, right? So it's important for, investors to really be savvy on what's available out there in the market and really talk to operators about what's on the horizon, from an acquisitions perspective that might be eligible. Because another thing that's important for investors to understand is not all potential investments are eligible, for a 1031 exchange. For example, there are some lenders that prefer not to allow a 1031 exchange investor to come into their deal. So maybe you can speak to that a little bit more, just reaffirm, what I'm saying.
Yeah, it's, lenders, for most people, and we do a lot of seminars for lenders too, to kind of walk them through this because it can be confusing. But yes, a lot of lenders, you'll have people that want to go get a loan for a primary residence, and it's going to be a 1031 exchange. So the lenders are like, well, wait, can we give them a primary loan even though this is going to be an investment property? The answer is no. I always tell people you can either commit tax fraud or mortgage fraud. So we're trying to make sure that you don't commit either one. But with lenders, it has to be for an investment or a property used in a business. And so, it doesn't work with the primary loans. So we've got a lot of lenders that understand it. So, if there's ever a situation with your current lender, we're on the phone with lenders quite often, walking them through this process and showing them how it all works. So the other timeline here is the 180-day timeline. So what that means is you've got the day you sell the relinquished property, you have 45 days to identify. After that 45th day at midnight, you have to have your list in on what you're going to do. That list can't change after the 45 days. So after 45 days, you're stuck with one of those three choices or however you identify the properties that you're considering to acquire. But you do get an additional 135 days to close. So the whole period is 180 calendar days from the day you close the relinquished property to the day that you have to acquire the new property or properties. So it's not 45 plus 180. That's the question we get a lot. It's 45 days plus an additional 135 days to close. So you do have time. The only time that changes is what the rule says is that it's whatever's soonest, the 180 days or the day you file your income tax return. So what that means is if you sell a property between October 17th and December 31st, today, interesting enough, comes sooner than the 180 days. Simple fix there. You can file an extension. Once you file your tax extension, which push you, back in October, you can go all the way to your 180 days. So if we do have clients that aren't going to be able to fit in that 180-day window, we'll simply call the CPA, have them file an extension, and give them the full 180 days to complete the transaction. Again, it begins at the close of the sale transaction. This slide could change because it says no extensions. There has been, just over these last few years, extensions created by the federal government. If there's a natural disaster, for instance, they could push that date. That just happened with COVID. We, in California had what they called a hurricane, which I lost a couple leaves on a tree. It wasn't anything major, but because the state filed a natural disaster, they did extend that guideline. So for all intents and purposes, there's no extensions beyond the 180 days unless there's what they call a natural disaster, which is very rare. So the qualified use requirement is you must have the intent to hold for investment. So where that comes into play, we have a lot of flippers, guys that want to go buy properties, fix them up, sell them, and then 1031 exchange into their next flip. The rule says your intent must be to hold for investment, and that can be very ambiguous what that means. What we have found is that if you hold a property for 2 tax cycles and you file 2 tax returns on the property, those have generally passed the audit, but it's not in the code. So the advice here is when you're going to go buy a property and you're going to ultimately move into it, no, you're not. You're only going to buy this property and hold for investment. If you're going to buy it and intend to fix it up and flip it and sell it for profit, the answer is no, you're not. You're going to always hold it for investment. So just go into the transaction with all the paperwork and all the emails and everything with my goal here is to buy the property, hold it for investment, cash flow it, doesn't have to even cash flow. It could be vacant property that doesn't cash flow, but it can't be a property that you're making it very clear you're going to buy and flip for profit, or you're going to buy and ultimately move into it. So as long as you keep that straight, you won't have any issues. But we do get the question, well, how long until I could move into it? If I buy a second home or a home that I'm ultimately going to use for retirement, can I do that? The answer is yes, but moving into it or starting into it, you want to just make it very clear that your intent is to hold it for investment. So this works with rental and income production, investment property, or property used in a business. As I mentioned, the property required to fix up and flip doesn't count. Condo conversions, or we get developers who are going to buy a big tract of land, build a bunch of houses, and try to sell it. Those don't qualify for 1031 exchange. So you really want to focus on my intent, which is to hold the property for investment.
That makes total sense. Is there any requirements as it relates to, an arm's length transaction at all? I assume that, this qualifies for both active and passive investments, if I'm saying that right.
Correct. Yeah, it's active, traditional. You can buy your own properties. You can do syndications like we talked about with the tenant in common or the Delaware Statutory Trust. The arm's length is more about immediate family members. So you want to be careful. They're on to the people. They're like, okay, I'm going to sell my property and then I'm going to buy my dad's property, and take his loan out and stuff like that. So immediate family, there's a lot of different moving parts when it comes to that. But if it's immediate family, that's when you're going to want to call me and let me walk you through and kind of look at what your situation is and how we can either get through it or, tell you that it's, red flag. We're not the IRS police. We don't call and tell on anyone, but what we want to make sure is that when you're sitting in front of an auditor, if you get audited, hopefully not, that we have you protected and we know that you walk through the right steps to follow the code and we can defend you if an audit were to occur. So anytime there's any moving parts like that, and there always are, by the way, we can show you, like I said, how easy a 1031 exchange is, but we have a phone call with every one of our clients, walk through the exact situation they're in. And again, it advise them on, this will fly, that won't fly. And then sometimes coming up with an alternative, for our clients. So, just got to be careful with it. As we mentioned, the reinvestment requirement is the investor must have the intent to reinvest in a like-kind replacement property. We're going to talk about the term like-kind because it's kind of a silly term on the next few slides, but basically you're going to sell real estate and you're going to buy real estate. Anything attached to the land qualifies as like-kind. So I could sell an apartment complex and I could buy a single-family home. I could sell an industrial center and I could buy an apartment complex. So everything qualifies, but that has to be your intent. Equal or greater fair market value. So what that means is if I sell a property for $1 million, I have to buy a property for $1 million. Now, there's something called the net sales price, which can reduce that number, and most of the time it does. What that means is there's permissible and non-permissible expenses. So if I sell the $1 million property and I have $200,000 in commission to a broker, I have title, I have escrow, I have legal fees. you can actually reduce that $1 million down by what they call the cost of sell, which is your net sales price. I have to walk people through that. Our sales team has to walk people through what that number really is. I think for this purpose, ultimately, whatever price you sell your property for is the price you need to buy your property for. If you're finding properties that come up a little bit less than that, we can um, plug in the net sales price and see, what that number is. The non-permissible expenses would be anything related to your loan or taxes. So if you take your sales price and you take out all the cost, as long as it's not regarding taxes or your loan, then that's what you have to buy the replacement property for. And we're happy to walk you through that. The other thing is the investor must reinvest 100% of the equity net cash proceeds into the replacement property. So where this comes up is people sell $1 million property, they have a $500,000 loan that gets paid off. Ultimately, they end up with $500,000, not a million, right? So they'll call us and say, well, I only just want to buy a $500,000 property. I don't want to have to get another loan. It doesn't work that way. They know that the loan went away, and so you're ultimately getting a gain there. So that's what they call mortgage boot. So you're going to have to actually pay taxes on that 500,000 loan that you had that you did not replace. So to make this very simple, all the cash that you get out of the sale of your property must be used. And if you buy equal or greater value, the loan will take care of itself, right? Because obviously to buy equal or greater value, you're going to have to get a loan with the amount of cash you have. Now, you don't have to do that, even though you must reinvest 100%. That's to not pay any taxes. We have a lot of investors that maybe they hit a home run and they, made $1 million in cash. Well, they want to diversify. They want to put some in equities. They want to put some in the stock market. They want to put, they want to buy gold. You can take cash out of your exchange, but you will pay tax on whatever cash you take out of that exchange or whatever debt you don't replace in that exchange. So, that can be a very expensive cash out. What we tell people a lot is it's better just to complete your exchange, buy your new rental property, and then do a cash out refi for some of the cash. That refi is not taxable because you're just borrowing money against the property that you own. You're borrowing your own equity. That can cost $4,000 or $5,000 to do a cash out refi, whereas you could be giving away 20 to 30 to 40% in some cases of any cash you take out of your exchange. So you can always add more cash, so you can buy more than $1 million property, but any cash you take out of your transaction would be taxable. So keep that in mind.
Yeah, no, that's great, Tommy, and I appreciate that. And hopefully people understand what Tommy's referring to here when he talks about these different debt replacement, rules. If not, definitely do please reach out to a member of the Rise48 team or to Tommy's team directly. One question that I've been getting quite a bit here, Tommy, is as it relates to those that own small businesses, maybe franchise brands, for example, that maybe are looking to, sell or exit, right? Are
Mhm.
those types of businesses eligible for 1031 exchanges, or maybe is it only the real estate if in fact the business actually owns real estate?
Yes, so it was. So, you used to be able to 1031 exchange, what we call, private or not private property, but personal property. So you used to be able to 1031 exchange your business, not just the real estate. You could do art, you could do marine, you could even do aircraft. The taxes changed in 2014 with the tax cuts. Now this is specifically for real estate. So we have a lot of instances. One of our guys, Mike Reese, who's on the call, he had a group of dentists that were selling their dental practices. So what they did is they own the buildings, they own the dental practice. We had to separate the value of the business with the value of the real estate because they could not 1031 exchange the value of the business. And so what, people try to do there is they try to get the highest value when selling a business, the highest value out of the real estate, and the least value out of the business itself. And that's a way that you can, exchange as much as you can for it. But after the 2014 tax cuts, They remove businesses and personal property out of that. So this is purely for the real estate, regardless if it's your business or not.
Perfect. One other question while we're here that I'd like you to comment on. Again, we're getting a lot of questions from investors that are streaming as well as on Zoom here. So I want to make sure that I get them all out there. But one question that's coming across is, what about the cash flow that the investor received over the course of the investment timeline or hold period? That
Mhm.
cash flow received is not included in their 1031 exchange. It's only their I guess the principal in investment in the relinquished property, as well as the profit participation coming from that relinquished property. Am I saying that right?
Yes, you are. So the cash flow that you earn, so the net operating income, um, that's taxed as ordinary income. So you're going to pay for that each year. Hopefully through depreciation on investment properties, like we talked about earlier. You can offset what that is, as much as you can. But the cash flow that you earn or the net operating income that you earn is taxed at ordinary income, just like your normal job would charge you. So you do again have write-offs on your property. You've got maintenance. You've got all the different stuff that you pay. So your rental income comes in. You have all your expenses that you had to pay, and then you have your net operating income. Um, that is what's taxed. And that is what can be offset by depreciating, that investment property. But that has nothing to do with the exchange. The exchange is purely bought a property for $200,000. I'm selling it for $400,000. I have a $200,000 gain. That's your capital gain tax, nothing to do with anything prior to that.
Yeah, appreciate that. And thank you for clarifying that. And just for those that are listening that are Rise 48 investors or investors in syndications, we do perform a cost segregation, study on all of our investment properties every year. And that in and of itself produces enough depreciation tax benefits to you as an investor to mitigate, the capital gains tax consequences on the passive income that you're receiving through Rise 48 investments. So hopefully that clarifies it for those that are investors with us.
Yeah, it's very smart. So, cost segregation means that instead of depreciating the property over a 25 to 30-year process, they can itemize every single detail in the property and get that depreciation much quicker. None of us generally hold properties for, 30 years anymore. So to get that depreciation as quick as possible is very important and will really, relieve you have paying even that ordinary income tax. So it's great that Rise 48 does that. So this is the term that, I told you was a little bit silly because people get very confused and go, well, if I sell a multifamily, I have to buy one because that's like kind. These are all considered like kind properties. So I can sell a single family and buy a retail, industrial. I could buy vacant land. You can even buy oil and gas interest, although that can be, very difficult and very volatile. Mineral interest, so anything attached to the land. Most of you know what most of these are. The ones I do kind of want to get into quickly is a 30 plus year lease. So people do sell properties. What we're seeing a lot of is cell towers, right? So people own a property. You'll have Verizon and AT&T come out and put a cell tower, up on their property. That lease that Verizon's paying can be for 30 years. So they're going to lease that piece of property for 30 years. They can actually sell that lease and 1031 exchange it because the lease has 30 plus years on it. The IRS looks at a lease that's 30 years or more as an asset. Anything less than that, they look at as rent. So they look at it as income. So it's pretty rare. We see it again in the cell tower industry. But for all intent purposes, if you are selling a property or if you're going to, sell a property and ended up buying a property that you're not going to actually get title of the property, you're going to actually get, interest in the lease. If that lease has 30 plus years on it, it would qualify. So those are pretty special circumstances that you'll definitely want to talk to us about because there's the actual lease, then there's extensions, and then, all of that. So there's a lot to look into those leases. We've already discussed the TIC and the DST, tenant in common or Delaware statutory trust. That's simply fractional property interest. So that's syndications, like we talked about. And development would work if you plan on to hold the property, develop it, rent it out. And then, what they look at with that is, did you rent it 2 out of the previous 5 years? Development, again, very touchy subject. Most of the time, I'll tell you honestly, development does not work. We've got a lot of developers who try to use it. But what we look at is development could look more like a partnership, and we don't really like to do 1031 exchanges into development. But again, if that's the move you want to make, and if that's what your CPA is advising you to do, we're happy to walk you through how to do that and make sure that it qualifies for 1031 exchanges. So the non-like kind properties, which obviously makes sense, is your primary residence, the property held for sale. So that's what we talked about, the flips, the development type stuff, cash, stocks, bonds, mutual funds, REITs. There is a way to exchange into REITs. It's a little bit more complicated. You don't actually change into a REIT. So what a REIT is a real estate investment trust. What that means is instead of owning the property, you own shares in a property or a group of properties in most cases. We do have people that want to go into REITs. It's called a 721 up REIT. And so what you're seeing a lot of these broker dealers doing is you're going to 1031 exchange into a DST. Remember, we talked about the Delaware statutory trust. So you 1031 exchange into that, which does qualify. Ultimately, they take that Delaware statutory trust property or properties and they move them into a REIT through what they call a 721 up REIT. So it's like a 1031, but a 721. Once that happens, all the money that you've invested, including your principal and any profits, are given to you in shares. That can be good for certain exit strategies because now I have shares instead of cash, and I no longer have to exchange. I have all my principal and all my profits now in these shares. I can immediately sell my shares of up to what my basis was because that's just a return of your initial capital. So that can be a tax-free, situation. Where it doesn't make sense and where we don't highly recommend it is you can no longer exchange out of that. So all the profits that you've made over that lifetime of holding these properties and exchanging them, every time you cash out any of those shares, they will be taxable. So a REIT is kind of an end game for your wealth building tool. It's a way to get some liquidity, but then end up paying taxes, ultimately on the other side. A lot of broker dealers, a lot of financial advisors love that, because again, it goes into what they manage. I do think it's a great tool. We do a lot of them. There's a lot of great companies that do that, but keep in mind, that's the end of the road when it comes to your 1031 exchange. It's best to probably continue to 1031 exchange, and then you'll end up never paying those taxes. And again, like we talked about, step up in basis at the date of death. We already talked about partnership interests. That's just simply you can't come out of partnership interest or buy into partnership interest with the 1031 exchange. You have to buy real estate. You can't buy shares in a corporation. If you just keep in mind, you sell real estate, you got to buy real estate. This will be pretty simple for you.
Yeah, no, I appreciate that, Tommy. And I wanted to highlight one thing, and that is I'm really glad that you talked about the 721 up REIT. The reason for that is because for those that are investors with Rise, today they know that we currently own, manage, and operate over $2 billion in real estate. And there may become a time in the future, depending upon where we're at in the market cycle and if it makes sense to sell, that we may be offloading, 10 to 20 properties all at once, to potentially a large institutional buyer like a private equity group or something like that. So with
Mhm.
that type of a large transaction, we likely won't be able to find something big enough to buy, right?
Right,
And
right.
so that's
Yep.
kind of where the, 721 uprate, comes into place, and Rise is in the process of establishing a 721 uprate in preparation for that potential future transaction.
Yeah, and that's, I'm glad you said that. When you get to that size of portfolios, you go sell a portfolio that big, it's really hard in 45 days to go out and identify, what you're going to put all that money into. And that is the perfect exit strategy for a portfolio that size, for sure. I feel like we kind of walked through this already, so we won't get too deep. But again, a tenancy in common is a tick. Getting co-ownership, you can have multiple investors. The rule is you can have up to 35 investors in a tick. No bank will really go for that anymore. So they really look for, 3 to 5 investors. Then you've also got your sponsor like Rise48 who's going to be on there with you. So, that's again, you got voting rights, but it's a great way to get into more institutional type real estate. A lot of people look at it and go, I wonder how, I can own a large apartment building or how I can own, a shopping center. Most of those come through the TIC structures. So you've got people that will buy them, and then you've got fractional ownership interest in the people that, put that together. The DST, again, these are just the two fractional ownership interest ways to do it. The DST differences, again, the trust owns the property, the trustee makes all the decisions. You're simply a beneficiary of that trust. The banks, in the 2004, I forgot the name of the bill that came out, but it's the 2004 bill. The banks really came up with the Delaware Statutory Trust, meaning that they didn't love having a bunch of investors on the properties that they were loaning to. So this is kind of what they came up with, hey, let's make sure that there's one trustee that we deal with. They sign the loan docs, and then there can be multiple investors. You can have up to 500 or 500 beneficiaries in a DST. So those are really more long-term holds, where you're dealing with more institutional type stuff. But really, the TIC and the DST are the two ways to get into fractional ownership interest if you hear those terms. So just real quick, I know no one likes case studies, but I just needed to make it very clear what happens with taxes. And the reason being is we have a lot of investors that call us and say, my CPA said just pay the tax, it's only 15%. And we have to explain to them that's just your federal tax. And what this tax is based on is that gain. So, like I said, you bought a $200,000 property, you sold it for four, you have a $200,000 gain there. So in this case, you'd pay 15% on that 200,000. It can get up to, based on how much the gain is, it can get up to 20%. Then you have depreciation recapture. As we talked about, you're going to depreciate your investment property to offset that rental income or the net operating income that you get. When you do cost segregations, you're going to depreciate much quicker than the standard rate. So if you don't do a 1031 exchange, then you have to pay back 25% of what you depreciated. So that number can get up there pretty quick. We'll have investors that call and go, well, I've owned this property for 50 years. I bought it for $2 million. Well, if they sell it and don't do a 1031 exchange, they're going to be hit with the 20% federal right out of the gate. And imagine 25% paying back of all the depreciation that you took during that holding period. So that can get very high. Then you have the healthcare reform tax rate, which is 3.8% of any passive income over 250,000. So you have your job, you're earning your income, all that's great. You go sell a rental property and you made $260,000. That's when the 3.8% can kick in, because anything over $250,000 in passive income, even if you sold some stocks and bonds and gold and all that other stuff, that's all your passive income. So as that passive income reaches over the $250,000 mark, that's when the 3.8% gets kicked in. Then you've got your state tax. You've got certain states like Texas and Tennessee, Nevada that don't have state income tax. That's great. Most states do. So then you got to add in, your state tax too, which, in California, which is, a state most people aren't looking at today. That can reach as high as 13.3%. So lots of taxes. On the next slide, we'll kind of show you how that works out. So real quick, assuming that somebody buys a property for $500,000, holds it for 10 years and sells it for $1 million. That can be a very standard type transaction in today's world. So during that 10-year period, you took $200,000 in depreciation, right? So your total capital gain is going to be $500,000. You've got $100,000 in federal tax, that's your 20%. You've got $19,000 in the Medicare tax, that's the 3.8. You got in California, that would be 10.3%, which is another 51,000. And 25% of what you depreciated is another $50,000 in tax. And that's the one that a lot of people miss. And they go, well, I didn't even make any money. Yeah, well, you depreciate it. You still owe taxes, even if you didn't make a gain. So ultimately, that $500,000 you would have made is now down to $279,500, which means you lost 44% of what you made on that property that you held for 10 years by not doing a 1031 exchange. So if we go to the next slide, I'll show you if you do a 1031 exchange, how that really can affect you. So just to make this very simple, you did a 1031 exchange, and let's start here on the bottom. So, well, let's start at the top, actually. You didn't do a 1031 exchange. Remember, you had $279,000 left over. You go get a loan for 50%. So now you can go buy a $558,000 property. Let's assume that your gross scheduled income on your $558,000 property is $55,800 a year. So great, you made $279,000, you paid a bunch in taxes, now you're making $55,000 a year. Not a horrible deal. Now, if you would have used a 1031 exchange, you get all $500,000 that you had instead of giving any away in taxes. You'll get the same 50% loan. So now you're buying $1 million property instead of a $558,000 property. And at that same 10% gross scheduled income, you're making $100,000 a year. So the issue here is you're losing significant money. So it's not just about not paying taxes. It's about continuing to have your money work for you and continuing to build your wealth. And so that's the key to this. It's not just how do I get out of taxes? It's how do I continue to build my income and not give away money to, what we call the worst charity on earth, the IRS. If you want to give it away to, the charity on, whatever you choose to do. So
Yeah, it's really the seventh wonder of the world, and that's compounding, right? And one thing you didn't mention, but it's very obvious here, and that is you're really using the IRS's money to produce an additional return for yourself. Am I saying that right?
100%. Yep. Yep. They gave us this gift, and it's important to use it as much as you can. There's not a lot of gifts that the tax people give us. So, what I say is if you're planning on using the money to buy real estate, there's no reason not to use this. And, Jeremy and I were talking yesterday, when does it not make sense to do it? Well, it doesn't make sense to do it if you've got, massive debts that you need to take care of. There's no point in rolling money into real estate when, you're paying high interest rates on credit cards and stuff like that. If, you don't have a massive amount of gain and you can take that money and kind of stop the cycle, that's very rare that it happens. But again, if you call us, we're advisors, and you're not going to hear this from a lot of other exchange companies, but we have been in several meetings where it's like, this doesn't really make sense. Like sometimes it doesn't make sense to sell the property. You're earning a great income. You've got plenty of depreciation left over. You've got plenty of, maintenance that's not necessary. So it really doesn't make sense to sell this property at this point because there's not a lot of things you can move into, in that case. But, for the most part, it makes sense. But, it's always important to call us, and we'll be the first to tell you, how this makes sense. So, our fee is, generally it's $9.95 to do an exchange. So it's really not, for us, it creates no value for us to tell you, to sell a property and do an exchange if it doesn't really make sense, because all it's going to happen, you're going to get your CPA and they're going to go, why did you do this? And why did you do an exchange? And then, we're going to look bad. So we'll always advise you on the right thing to do to help you and your family and to build wealth. One more quick thing about us. So again, we're investors 1031 exchange. We're in all 50 states. We've got offices in New York, Dallas, LA, San Francisco, Seattle now, which is our newest office. So we're everywhere, but we handle exchanges not only nationally, but even internationally that we didn't really talk about, but you can do foreign exchanges too. But that's a whole different thing. Our big thing is to be a partnership with you guys. So we don't just hold your money and advise you on taxes. What we're there for is to walk you through the process, show you, guys like Rise48 and Jeremy, who we do good business with, and we really want to be your partner with your investment. We call ourselves advisors. We don't call ourselves, a QI or an accommodator. The other thing that we do is we help people sell properties. If you're trying to sell a property and you want to, put it in front of our group, we have a deal room on our website. So you can actually, if you're a broker or if you're, a principal on a property and you're like, you know what, I want to see what's going to happen with my property. I want to see if anybody invites on it. We have over 40,000 investors we've worked with or done exchanges with. So an added value that we don't charge for is we'll take those deals, upload them into our deal room, and give our investors an opportunity to see, what's out there. So a lot of times we can move properties for you like that, and then, get you over to, your next investment. So that's kind of what we talked about with the deal room. So again, our headquarters are here in Solana Beach, which is in San Diego. I'm originally from Texas, so spent a lot of time there. Utah is another one of our offices, but we can handle your transaction everywhere. I appreciate the time today. One last thing is we did write a complete guide to 1031 exchanges through Jeremy. If you guys want a copy of that, we can actually get you, a copy of our guidebook that'll kind of go through all the details that we just talked about today. So
Yeah, sounds
appreciate the
good.
time and
Yeah.
appreciate you, Jeremy. Thanks for
Yeah.
setting this up.
Yeah, of course. And if you don't mind sticking around for just a couple more minutes, I've got kind of a few other questions that are circling in here. One question that Edward asks is, are you a qualified intermediary? And the answer to that is yes. Tommy Hinson and his firm, Investors 1031 Exchange, they are a qualified intermediary or QI. Another question that we kind of addressed this a little bit already, I think, but maybe we can restate it. And that is, when is the right time to engage a qualified intermediary for a 1031 exchange? I know I kind of gave my, 2 cents on that topic, but Tommy, maybe if you're going to want to weigh in there as well, that'd be great.
Yeah, no, that's a great question, and I should probably add that to the presentation. Once you get into escrow on the property that you're going to sell, so we can talk about it. If you're considering selling, no reason not to connect with me, and I can kind of walk you through what the process is. But where we need to be engaged is the second the property goes under contract, and then it goes to the attorney, title company, or escrow company. That's when those groups start to create paperwork, and we're going to have some information that we need to get from them and provide them so that they don't have to redo that paperwork. So, you don't have to get in contact with your QI or your accommodator prior to being in escrow. But if you want to go through, a plan and a strategy prior, we do that all the time. But we'll definitely want to get in touch with your title, escrow, or attorney as soon as that contract gets sent to them so that we can make sure they don't do double the paperwork.
That sounds good. I appreciate that. And I've got a ton of questions here related to Rise48 and what is on our timeline as far as different deals that we're in the process of going after. So for those investors that have asked questions about Rise48's current deal flow, please do reach out to myself, Jeremy Dyer, or a member on our team, and we will let you know what is coming down the timeline or pipeline here. So with that said, Tommy, I really appreciate the tremendous value, that you brought us today, and thanks for joining.
Yeah, appreciate the time, guys. Thanks.
Absolutely. And thank you, everybody, for jumping in here again. We really appreciate you spending your time with us this morning or this afternoon, depending upon where you're dialing in from. And we look forward to catching up with you soon. Thank you.